If this was the top, nobody would know. I mean, that's how tops are generally made, or bottoms. Like, you don't really realize that you're at the top until you're a long way down, right? The market, they don't ring a bell at the top or the bottom. When you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over. And in the case of gold, it's a bull market, and these sharp corrections are designed to scare out the weaker players, people who may have just come into the market more recently, and just kind of get rid of them, get rid of the dead weight, the excess baggage before we move up to new highs. But the media acts like, oh, this is the top, right? Get out.
In today's news recap, JP Morgan sees gold shining at $5,000 by 2026. JP Morgan analysts on Thursday maintained a bullish outlook on gold, forecasting prices could reach an average of $5,055 per ounce by the fourth quarter of 2026. The forecast is based on demand assumptions that see investor demand and central bank buying averaging around 566 tons a quarter in 2026, the bank said in a note. Gold remains our highest conviction long for the year, and we see further upside as the market enters a Fed rate cutting cycle, Natasha Kaneva, head of Global Commodities Strategy at JP Morgan, said. The combination of a Fed cutting cycle with overlays of stagflation anxiety, concerns around Fed independence, and broader debasement hedging supports gold's upside, Gregory Shearer, head of base and precious metals strategy, said. So let me get this straight. Is JP Morgan going to nail this one, or are they just talking their book? Is this a classic sell the news? What do you think, you guys? On the dollar, the bank noted that the rally is not a de-dollarization or not a debasement story, but it is most likely a dollar diversification story, highlighting that foreign holders of U.S. assets are gradually redirecting small allocations into gold. JP Morgan analysts also highlighted that recent market consolidation is healthy. The pullback reflects the market digesting the rapid price gains since August, said Kaneva. It's normal if you're paralyzed with fear because the price moved so fast. It's just a very clean story. You have a lot of buyers and you have no sellers, she said. She reiterated a long-term target of $6,000 per ounce by 2028, stressing that gold should be viewed on a multi-year horizon. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
We've had a pullback in both gold and silver. They're now in correction territory. Corrections are very normal in a bull market. Gold is now off about 6.4% from its record high, and silver is off about 11% from its record high. But number one, I think the most significant aspect of the gold correction is that we didn't correct from 4,000. We corrected to 4,000, meaning that the correction started well above 4,000. It's not like we ran into resistance at 4,000, which is what a lot of people would expect at a big round number like that. I mean, typically, psychologically, you get resistance. We had it at $2,000 gold. We had it at $3,000 gold, though not quite as much as we had at 2,000. But a lot of people would have expected that 4,000 to be some type of resistance that, could cause a pullback, and it may take a little while for the market to muscle through 4,000. Instead, we went through it like a hot knife through butter. Yes, we had a correction, but we fell down to 4,000. 4,000 now looks like the floor for the price of silver. Now, instead of being emboldened by that, because if 4,000 is the new floor for gold, that is great news for the gold mining companies. But you wouldn't know that by looking at what happened to those stocks. The GDX is now down 14.5% from its high last week, and the GDXJ is down 15.5%, And pretty much every silver stock is in a bear market, right? Down more than 20%, even though silver is at 48.5, which is a very high price for silver. And the fact that it was able to get through 50 all the way up almost to 55, I think should be encouraging news for silver stock buyers, because it shows that 50 isn't the ceiling anymore. We went through 50. And yes, we're back below it now, but I doubt we'll stay below it for long. Now, getting back, though, to gold and 4,000, I think 4,000 is the new 3,000. And if you recall, when we got above $3,000 gold, we did dip below it a couple of times, but we didn't stay below it very long. It really was the floor. The same thing is probably going to happen with 4,000. Now, I wouldn't be surprised if the market went back below 4,000, especially since it came so close this week at 4,016. Now, maybe that was the low. Maybe this is the end of the correction. But it's also very possible that that's not the low, that the market retests that number and maybe goes a little lower than that in order to shake out some of the speculators who may be, buying it now and putting some stops below that low, or maybe below 4,000, hoping that it won't go down there, and trying to get, kind of a low risk trade where I'm buying gold at 4,100, or maybe they got in a little lower and I'll get out if it gets below 4,000 or something like that. So there could be some people trying to do that, and, they may get stopped out. Then again, they may not. I don't know, but I don't even care, because I think that if we do go back below 4,000, it's only going to be very briefly, and mainly probably just to flush out those stops. And then the market will come back up. So I think we're headed a lot higher. I think the fact that gold went above 4,000 is a very bullish sign. But what's also very bullish to me is how the media, the financial media in particular, is covering gold's rally, and more important, its decline, because they're treating it like this is the end of some kind of speculative mania.
Massive news from India today. India unleashes silver as bank collateral with 10-to-1 gold-silver ratio, boosting global money roll. India formally recognizes silver as bank collateral with a 10-to-1 gold-silver ratio, reshaping lending, boosting demand, and igniting a new era for silver as a global monetary metal. India has taken a historic step toward the remonetization of silver, officially allowing the white metal to serve as collateral for bank and non-bank loans under new Reserve Bank of India regulations set to take effect in April 2026. The move effectively establishes a 10-to-1 silver to gold ratio in collateral lending, marking the first time a major economy has formally recognized silver's role alongside gold in modern banking. Silver joins gold in India's banking system. For decades, Indian households have relied on gold jewelry as a primary form of collateral for personal and business loans, especially in rural areas with limited access to credit. The new rules expand that privilege to silver jewelry and ornaments, enabling borrowers to pledge up to 10 kilograms of silver or 1 kilogram of gold as collateral for loans of up to 2.5 lakh, approximately 3,000 USD. The policy applies to both banks and non-banking financial companies, a sector that services millions of small borrowers, and introduces uniform valuation and documentation standards to ensure transparency. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
The way they covered that was as a positive. They said, well, this just shows that interest in Bitcoin is spreading, right? Now you have more investor interest in Bitcoin, and so it's a good thing. And so money going into Bitcoin ETFs was a positive for Bitcoin, but somehow it's a negative for gold. Now, I think that, yes, it could be a very short-term negative in that we got a correction, right? A bunch of people rushed in, and now we get a correction. And that's probably the last couple of weeks, not the last 4 months, because it wasn't until very recently that gold started rising at an accelerated pace. But I do think that the fact that we finally have some inflows into gold ETFs and that they are significant, to me, does indicate that investors are finally getting interested in gold. Now, they're not interested enough, and there's not enough of them who have gotten interested. But now, after having no interest whatsoever, they're finally starting to recognize that they should buy gold. And I think that that is a good sign, because I don't think that the money that came into ETFs in the last few months is done. That now that gold has pulled back from 43 and change back to 4,100, that whatever interest was prompted is now gone. No, I think that's the tip of the iceberg. We have a lot of money that's going to be following up. Now, yes, there may have been some short-term leverage speculators that got burned because they came in late and they got surprised by a big correction. That's possible. But all of this is normal in a bull market. And as I've been pointing out, the biggest moves in any bull market, and this is not just for gold, but in general, when you're in a bull market, the biggest moves are down. Just like in a bear market, the biggest moves are up. And that's because the market is trying to fool people into thinking that either the bull market is over or the bear market is over. And in the case of gold, it's a bull market, and these sharp corrections are designed to scare out the weaker players, people who may have just come into the market more recently, and just kind of get rid of them, get rid of the dead weight, the excess baggage before we move up to new highs. But the media acts like, oh, this is the top, right? Get out. If this was the top, nobody would know. I mean, that's how tops are generally made, or bottoms. Like, you don't really realize that you're at the top until you're a long way down, right? The market, they don't ring a bell at the top or the bottom. And so you don't get this big drop that says, aha, the gold bull market is over. No, these big drops like that are a sign that the bull market is alive and well. It just has this correction. And of course, the market was getting overbought. Of course, not overowned. Overbought is a technical term because very few investors own gold. Gold ownership among institutional investors and retail investors is historically low. That's why a lot more money is going to come in. But again, what's also very significant is that the central bank buying is not even close to ending. They are ongoing buyers. They are buying for a reason. They need to increase their gold reserves. They need to decrease their US dollar reserves. And so this is going to happen regardless of the price of gold, right? They are buying, and they're not buying their gold to turn around and sell it. They're buying their gold to hold it in reserve to provide backing for their own currency, backing that they can no longer really have with the US dollar or US treasuries, given the likely decline in the value of the dollar and treasuries. And so they are divesting. And so this is going to continue, but the investor interest, I think, is going to continue to pick up in gold and silver. So I don't think the highs that were established last week and earlier this week, those are not the highs. Those are just a temporary high. I would be surprised if we didn't take those highs out before the end of the year. We could easily move quite a bit higher than those highs. We're not getting a lot of economic news because of the government shutdown. We do get an FOMC meeting next week that could be a catalyst for another move up in the price of gold. The Fed is expected to cut rates yet again. And that is despite the news that we got today. We finally got some government economic data. I guess they forced them to do this even though we're in a shutdown. They released earlier this morning the CPI numbers for September. And consumer prices rose 0.3 on the month, which was a bit below the consensus of 0.4. But the more significant number is that year over year, CPI is up 3%. Now, that's 0.1% hotter than the prior month, slightly below the 3.1% that analysts had expected. But what's more significant is the sequential number going up. So we were at 2.9. We didn't go down from 2.9. We went up to 3. Now, remember, the Fed claims that its target is 2. So if your target is 2, and in the last month, you moved up from 2.9 to 3, so you're 50% above target and you're headed in the wrong direction, what would you expect the Fed's next move to be? Well, it should be a hike, right? If inflation is 50% above target and rising, and the stock market is at a record high. By the way, all three of the major stock market indexes, the S&P, the Dow, and the NASDAQ, hit new record highs today. In fact, the Dow today closed for the first time ever above 47,000, excuse me. Again, this is a nominal high, not adjusted for inflation or the price of gold. But you've got record high stock prices. You've got $4,100 gold. You've got inflation 50% above target and rising. Right? The Fed should hike, yet the Fed is about to cut. Right? And that's one of the reasons, right, that the markets are where they are, including gold, that the Fed is going to do the wrong thing. So we'll see how the market reacts to this next week.
What do you think of today's episode? Do you believe in Peter Schiff's take that this is a great opportunity to stack more gold and silver, or are the stackers going to be the ones holding the baby as the meltdown continues? Post in the comments section your plan for gold and silver, and share with the stackers if you are taking any profits after the mega rally we experienced this year so far. Now, check